What's up, everyone? This is host Raja Banks from New York Session live streams. Now, today we're going to go over all the trades taken last week. Last week was an incredible week, profited over $250,000, $252,000. It was incredible. Main reason why was because I think I increased my lot sizes and really played off of volume. So we're going to go over each and every trade which we think was important, um, which the reason why we gained these sort of returns. So the first trade we're going to talk about is going to be a buy, which was on gold. This was done on the 8th of August, and that was a $40,000 profit right there from one trade with a 125 lots. So let's move on to the left-hand side, and yeah, this was a trade right here. Now, for this one trade, didn't look at the high time frames, didn't look at the daily or the bias, didn't check that bias at all. This was a Monday, and price is just consolidating at this time, right? Now, one main thing is before you take a trade, you need to understand, do you have enough range, right? Do you have enough range to take that trade? So that's the first thing I checked on this one right here. So if you measure, so this was the resistance at 1778. Now, if you measure this resistance down towards this area, this is a 50 pip range, right? Now, obviously the range is all the way down till here, 1771, um, 66 pips. But when we had this clean candle forming and the next candle closed bullish, right? This meant that there's support formed, right? And if we have a support formed and the range from the high of this current candle is around, 40 pips, so I think there's a very good probability price can continue to push up. And that's where this trade was taken. This was a buy taken right here, 1774. Stops were obviously trailed, so you can't really see where the stop was. We basically closed 90%, and then the rest got stopped out. So basically, took the trade right here. Price went in profits, and since this was high volume, right? Even though the candle closed in the wick on the top, if this was high volume, there's a high probability that price will continue to push up till 1778, right? So held the trade during pre-London, London Open, and basically we continue to move up. Now also remember this trade was taken after this low was formed, because if you look at the time, this was taken at around 13 minutes past the hour open. So we're going to take a look at that here as well together. Let's scroll all the way to 8th August here. Just bear with me. Yeah, see, so this was the start, and this is where the trade was executed. Once we broke above its own high after making that low at the bottom. So if we look on the 5-minute time frame, we can see exactly when this trade was executed. So it's always important, if you think price is going to continue to push up, you have to make sure it makes the low first, because look at the time at the bottom, right? Already made a low. This was a candle start. The 1 hour candle started right here, moved down bearish, and then it started to break its own high. So I executed a buy at that point. So if you look on the 30-minute, you see that same situation right here. Let's zoom in here a little bit, and you can see where price formed, wicked down, broke its own high again, executed the trade. Also, it was an impulse entry. We had clean range to the left hand side, 34, 35 pips, won the trade, called it a day. Now, that was one trade from Monday. Now we moved on to Tuesday, and Tuesday, our first trade was a losing trade on a 75 lot, and then we had a winning trade. This was on the same day where price moved. So we're going to take a look at that right now. So this was a buy taken at pre-London, right? 30-minute candle was bearish at this point. Anticipated price to move up. Actually, anticipated price to break above this resistance right here. And the entire reason why this trade was even thought about was because of the daily time frame. Let's take a look at this, right? Let's take a look at this together, the daily time frame. Now, if you look at this daily candle, this is where this trade was executed on. If we don't have all this information to the left hand side, this current daily candle, this was bullish. We had the previous daily candle very, very bullish before the weekend ended, and now we were anticipating price to continue pushing up, break above the high, and continue on towards 1808, because there was a clean range to the left hand side. So the whole idea was based off of the daily candle, that if the daily candle can respect its low, then there's a high probability for price to continue to push up. Like, okay, perfect. Now, looking on the 4-hour time frame, this is where the trade was executed on right here. When the previous 4-hour candle was bearish, expected for this 4-hour candle to create a support, and then we could continue to push up with the London session volume. Now, I guess the first entry was too early, so lost that trade. Let's take a look on the 1-hour time frame, and we'll get you some more information here. Now, looking at the 1-hour time frame, the trade was executed right here, right, and the stops were kept below 1782, which was the low of the daily candle, right? Now, price went in profits, expected price to break above 1790 and continue to push up till 1799 and even 1800. But before that could happen, price came down, managed risk, closed the trade, and waited for another opportunity. Right, mind you, this was pre-London, so expected volume to come into pre-London for price to continue to push up. Right, so lost that trade. Next, now this was executed almost like 2 hours after this loss, because now we wanted to wait and see when the volumes are going to come in. Next, we had the 1-hour candle that basically pushed down towards the daily low around 1783, closed bullish, and guess what we had now? We had the London Open for price to continue to possibly continue to push up, right? London Open brings in a lot of volume, so you can see right here, this trade was actually executed as this 1-hour candle broke the high of the previous 1-hour candle. This happened in the beginning of the 1-hour candle. When it broke the high, trade was executed, stops were kept below, this current 1-hour candle, and expected price to continue to push up. Now, when price moved in profits, we put stops at break even. Stops were kept at break even so that if price does retrace, we don't get end the trade in a loss. So now the 1-hour candle pushed up, looked at the 4-hour candle, 4-hour candle, obviously, it was really, really pushing up, and we had anticipated price to continue up towards 1793. But I guess there was so much daily volume to continue to push price up. We continued all the way up till 1797, almost 100 pips at that trade, and closed the trade right then and there. So this was a perfect example of letting a trade run on, let's say, a 1-hour time frame, the 4-hour time frame, by keeping the higher time frame in mind. That's why this trade was kept open, so that price can continue on towards like where our analysis was based on the daily time frame. Now, obviously, price came down, came this close to stopping us out at break even, this close, but you know, I guess there was volume, price went up, secured the trade, and basically called it a day. Now, moving on towards the next day. Next day, there was a $22,000 win. Now, this $124,000, it was great. Some people said, oh, I took it with 0.01 lot and I could have, made more money, but I didn't. Understand this. When price moves, it moves the same way for everybody, the exact same way for everybody, right? The only difference is what lot size are you going to use. I'm using the lot size I should be using based on my account, my $2.5 million account, right? So you got to look at your account, and then you got to see what lot size you want to use. Now, think about this: $2.5 million, 125 lot, right? If you have $200,000, $220,000, that comes up to 12.5 lots, right? If you have $22,000, then that comes up to 1.2 lots, right? So using a 125 lot on the $2.2 million account is not a big deal at all. Now, let's move on to the next trade here. So this one was actually very, very simple. This trade right here, this is where the buy was taken for price to move up. It was basically very simple. We essentially had, so before we do that, again, the high time frame was not consulted. Didn't take a look at that. Only looked at the 1-hour time frame and the 30-minute time frame here for this lovely buy that I took. So basically, what happened was, looking out on the 1-hour time frame. Yes, right here. Price was coming down, and we created support in an uptrend. Once support was formed, opened the trade, it basically went in profits. That's exactly what happened. Looking at the 30-minute time frame, candle closed bullish, strong bullish candle. We had, like around London Open, pre-London, volume time, took a buy, price moved around. What was this, like, 18 pip win, 22,000 on a 12 lot. Perfect. Called it that session right there. And then we came back towards, I think this was your CPI on the 10th, was it? Let's take a look over here. 10th was actually CPI. So let's take a look at those trades right now. Next was $1,000 loss this same day. And we're going to talk about how this was $1,000 loss. Let's see here. So we got to break it down towards the 15-minute. Let's break this down right here. Okay, so this idea was also very simple. Basically, what happened was price came down right here. So this is a 15-minute time frame. Let's move on to the 1 hour time frame. Um, okay, this was it right here, right? This was in the pre-London, and then this was the idea I wanted to trade on to take buys for price to move up. And for reference, let me take a look. Now, this big candle, this is the CPI here. So let's take a look at this right here. Looking at the 30-minute time frame, this was a very easy, simple buy. Okay, so basically what was happening was price came down, created resistance, clean candle, just like we had, um, like, right here, right, for price to move up. So we came down, clean candle, took a buy right here, right? This $1,000 right here. Took a buy here. Price broke the high. So I took a buy, anticipated price to move up, but it came down. It was going further down than the 15-minute. I think we managed this trade on the 5-minute right here. I think we managed it on the 5-minute here. So let's scroll here. How do I lost $1,000 on a 25 lot? Okay, so yeah, it was basically right. Basically, the whole idea was for price breaking the high of the previous candle and then moving up right here. So manage the trade. Actually, I closed it because this was before NY Open, and if I've looked at my history of trading, I've lost a trade before NY Open, but this seemed too good to be true because price broke the high and there was a high probability for price to continue to push up. So this trade I closed because I was like, no, I'm not going to trade before NY Open. No, I've lost trades before. I'm not going to do that. But then I was like, no, no, Raja Banks, this makes sense. So I took the trade and basically won the trade because price moved up. So, it was like whatever trade. And then CPI came. CPI came and made some bad moves. The worst move. Okay, so here's what happens, right? Every time there's CPI or there's high volatile news event like FOMC, NFP, CPI. My whole idea is to have a buy stop and a sell stop. So sell stop is usually kept below a 30-minute candle, and buy stop is kept above a 30-minute candle. If there's a lot of volume, if there's a lot of volatility, and price is moving really, really quick, I tend to keep my buy stops and sell stops above a 15-minute and below the 15-minute candle respectively, whatever time frame I'm looking at. So in this case, what basically happened was that I had my sell stop initially right here around 1791. So this is the loss right here, right? So as price was moving, normally my sell stops and buy stops are activated when the news hit. So normally when this was moving, I kept on dragging my sell stop down. And I remember maybe like 10 seconds before 10 seconds before the news dropped. Right. So as price was forming, I kept moving my sell stop, and 5 seconds before spread jumped up to 8 pips, activated my sell stop. As my sell stop got activated, I hit close, and the move happened so quick. It was so quick that my stop got slipped by 100 pips, and that's where this $29,000 loss came from. But I had to keep my cool because the numbers were staggering and price moved with so much force that a lot of people got slipped. It's very normal on a lot of platforms, right? Some platforms stopped responding because the news came so quick and everyone got basically destroyed. Now, when price moves up with a lot of force, it always has to retrace almost 50% of the move. Always does a retracement. You can take a look at this with interest rates. You can take a look at this with NFP, CPI, like with the pound rates and all that stuff. Always retraces. Now, took this retracement down with a sell. This was a 50 lot sell. Looked at the 5-minute time frame. Scrolled. So, let's bring that over here again. We're looking at gold here. Let's scroll back a little bit, and this was on right here. We go right here. 5-minute candle formed a rejection. Once that rejection formed, we're like, okay, already made about $140,000 in the week. All we done there, 140 minus 29, 118, $15,000 during the week. Okay, so I can openly risk 20,000, right, for me to lose. This was like around, like 35, 40 pip stops, but this turned out to be 18 pip stop. So I was like, okay, you know what? I'm willing to lose around 30 to 40,000 and gain almost 50 to 60,000 as price would retrace. That was the whole concept. That was the whole idea. And that's why the sell was executed right here, risking 30 to 35,000 to be able to make much more than that and profit around $58,150 in that one trade, putting me net above for that whole day. Amazing trade. Now, what happened after that? Took the next day off, no trades that day, came back on the 12th. Came back on the 12th and had a really, really, really good sell on gold. Let's talk about that right now with the 150 lot. Okay, so this required some sort of this required some sort of a strategy here, right? Now, basically, we were looking at buys around above 1792, right? So this is 1792, 1792. We were looking at buys above 1792. We had the 30-minute candle close above this area. This was also high volume time. We have pre-London starting, half an hour after this. Looked at the 15-minute. On 15-minute, we had one candle close above, right? When this candle closed, the 30-minute candle was still closing at that point, right? The 30-minute candle hasn't closed. No, actually, this was the 30-minute candle close. What happened with the next 15-minute candle is very clear to us right here. Let's take a look at this. Let's go all the way towards, oh, this is right over here. Now, looking at the 5-minute, when the first 15-minute candle started, it moved all the way down. We moved up, and then we couldn't break the high at 1794. When we moved back to the 15-minute, we can see that this candle moved with a big exhaustion wick and moved up. I missed this trade. I missed when this candle formed. So when the 30-minute candle formed above this area, I missed it at there. I went to the chart, I opened the chart, and we were already forming a bearish candle. So I'm like, okay, you know what? That's fine. I've missed the opportunity for the breakout here because if we broke out, this was still 100, 14 pip trade at that point. So when I came to the charts, I saw the candle closing bearish. We're like, okay, perfect. I'm gonna wait for price to create some sort of a support, and then we could continue to push up. If we're breaking above 1792, this would be a very, very good move for price to continue on towards 1798, which happened later on in the New York session. So candle closed bearish. Next candle, when it broke the low, I start to think that, okay, if we're breaking the low at this point, this means that there's a very high chance this move up was a fake out. So if you understand the basic dynamics of a fake out, the market structure of a fake out, it's very simple. Price creates resistance, candle broke above resistance, we close back in the range. If we close back in the range, this means there's a high probability for price to move in the opposite end of the range. In this case, which was all the way down at 1786, around 50 pips away. So there's a high probability for price to do that rather than to continue to break up, because if it wanted to go up, it had to respect the low of the previous candle, but it didn't. It broke below the low. As it broke below the low, I was like, okay, you know what? Made great returns yesterday. How about we risk 50% of those returns and try to see if this would really be a fake out in times of volume for price to continue to push down. And remember, I keep talking about volume. Pre-London, London Open, pre-New York, New York Open, NYSE, and London close. Times of high volume at that time, right? Took the trade, price broke the low, came down, secured profits on a 150 lot, and called it a day at that point. That's it, right? You have to understand why you're taking the trades. Now, next two trades were in pound yen. These were almost like 2 hours apart. So we're going to take a look at these trades as well. This was a $800 win on a 75 lot. Amazing, right? And then there was a managed risk trade on a 50 lot. Let's talk about that. Now, this was very simple. The first sell on pound yen 75 lot was very simple. Price came down, create support, moved up. This candle closed with a rejection. This candle here formed resistance, right? But it didn't close above the steady. It actually broke below the low. So once it broke below the low, I took a sell. Price went down, and I missed my exit right here, and price started to move up. Once it started to move up, I was like, okay, you know what? It can retrace. So let me just take my profits. I closed my trade, $840. I'm like, okay, you know what? Perfect, whatever. Now, next, what happened was next there was a sell on pound yen, and this sell was taken the exact reason why I took the gold sell right here, right? Fake out, price came back in, sell, expected it to go down. On the pound yen, same idea. Candle broke above this resistance we had at 162.300, broke above. Next candle broke the low. As that candle broke the low, the sell was executed. Sell was executed at 162.284, 162.284. Sell was executed. Now, once the sell was executed, expected price to continue pushing down towards the support, which is a 40 pip range. Basic same idea as the last trade taken on gold, which made me huge returns, right? So this was also a Friday, so that's why I lowered my risk here. Price candle broke its own low, closed half, and then the candle basically broke the high of the previous candle, which indicates that price may continue to push up. So closed my entire position. So basically, risk on this trade was around 4,800, 44, $4,600, $4,800, and ended up losing $3,100. And then price still went in the same way as yesterday. um, yeah, so there was one lesson I learned from this loss. Now, whenever you have a loss, you learn lessons, right? One lesson I learned on this loss was because I should have trusted the 30-minute high, because essentially the candle didn't break the 30-minute high. It only broke the 15-minute high, and 15-minute time frame are weak confirmation time frames. So I think in future, when I'm managing trade, I may want to look at the high of the high time frame, which in this case was the 30-minute time frame, and not closed or not manage the entire full position on a smaller confirmation time frame, which is the 15-minute time frame. So I think should have just closed the 50% and let the rest run, which it did go. I hope this was somewhat educational to people, as it was to me here as well, because at the end of the day, go over your performances all the time. Always go over all your performances and see what could you have done something different. And 100% of the time, you're going to learn more than what you knew at that time. Take care, everyone. We'll see you on Monday.